I recently caught up with Jared Timms from Howden Insurance Brokers, and I really wanted an update on the PI market. And what I discovered was really interesting, having a look at how we came into a hard market and where we are today. And I thought it could be to benefit to the wider marketplace if I shared the information. Welcome, Jared.
G'day, Steve.
Mate, tell us a little bit about yourself and Howden.
Yeah, look, I've got a finance background, so I actually studied financial planning at uni. Happened to finish at around the end of the GFC, which made it quite tricky to get a role. And at the time, I guess the educational standards were a little bit different as well, in that a degree didn't actually get you into the industry. And funnily enough, I found myself working for one of the major insurers, Chubb, and ended up working in financial lines underwriting. So I actually used to write PI policies for the financial planning and broader financial services sector, as well as directors and officers. And yeah, for a number of years, I've been working on the broking side now, so assisting financial planners in arranging their PI for them.
Thanks, mate. Jared, we've been in a hard market. I suppose it's worth defining what a hard market is, particularly regarding PI and directors and officers insurance. Why did this happen, and what impact did it have for Australia?
Yeah, look, I guess so the insurance market tends to work in cycles. So a soft market is typically categorized by large inflows of capital. Insurers tend to sort of be competing for market share, and that typically means reduced rates to win market share. And a hard market, conversely, is the opposite of that, where there's restrictions in capital flow. We see insurers sort of far more selective in their risk, in their underwriting criteria and their risk selection, and usually willing to lose business by focusing on achieving the desired rates to achieve sort of long-term success. So yeah, it's much more sort of focused on profitability, and yeah, there's usually a lot less competition around.
The tightening of the market,
I guess
was that due to Brexit? Was it due to exogenous factors, and also then compounded by the Australian environment with regards to the banks and claims?
Yeah, look, it played out over a number of years. So I guess the first stage post GFC, we saw the withdrawal from Dual, Vero, and Axis, and I guess what happened was they were all fighting for market share. They didn't have a huge focus on their risk selection, in terms of they were writing everything up to the large dealer groups and writing them quite cheaply. And I guess post GFC, what happened was there was a number of claims resulting from allegations of incorrect risk profiling, product failure, over leverage, and not acting in the client's best interest. I think we saw circumstances where self-managed super funds might be set up in order to invest in property developments and agriculture schemes, which might have failed, and a few big large collapses like Storm Financial. So that was sort of the first stage. I guess what happened next, we saw Lloyd's in 2017 and 2018 had quite severe underwriting losses. And from there, it was a case of sort of trying to figure out what was going wrong. And two of the key areas that were driving the losses once they reviewed their portfolios was financial services, PI, and the construction sector was another poorly performing area. So consequently, we saw a hard market for PI, in particular financial planners and some sort of asset managers who venture further up the risk curve, and engineers and project managers and architects and whatnot on the construction side also went through a hard market. So yeah, I guess what it meant was it became much harder for people who operate in this sector to obtain PI, and a lot more expensive. And in some cases, businesses were simply uninsurable if they didn't have the right risk management in place.
With regards to PI for financial planners, where are we in the business cycle now?
Yeah, I think we're through the worst of it. I'm seeing a much more defensive stance from the PI insurers. Rate increases are kind of going out the window to some degree, and it's more about protecting their market share. We're not seeing a hugely aggressive stance in terms of rate decreases, but yeah, there's definitely a much more defensive stance in protecting their portfolios. I know that they've been running very profitably, and yeah, it's good business, and they don't want to lose it, particularly in the IFA space.
If we can't expect any falls in rates, what about, will we see an improvement on terms?
I think the terms currently are sort of quite fit for purpose. I don't think terms are really going to change, but I think that the good news story is that the IFAs have really been suffering hit after hit, year after year in terms of increases, and I think that's really starting to plateau.
We were sort of looking at 30% annual increases, certainly over the last 3 to 4 years. Was that sort of in your general experience?
Yeah, I think, yeah, definitely. And over the past few years, it sort of turned into a goal of achieving a rate increase of around 10%, and then coupled with revenue growth, the increases on the base premium percentage-wise were quite severe.
One of the issues has been that all roads lead back to London, in that it's really been Lloyd's that everyone goes back to. Are there other options within the marketplace?
Yes. Look, Lloyd's is one of the largest capacity providers, that's for sure. And in recent years, we've actually seen the withdrawal of AIG, who was sort of one of the large American players. But look, we're seeing much more competition sort of enter the sector. So new Lloyd's syndicates are willing to play now. There are another American insurer that is playing in the space, as well as European insurers, and even IAG, Insurance Australia Group, are actually putting out some capacity as well. So I think yeah, another reason for the hard market was the Royal Commission, and I think what happened there was insurers were just willing to sit on the sidelines and sort of see how it played out. And I think it's resulted in more professionalism across the industry. There's been a higher focus on compliance, and as a result, it's been a profitable sector, and insurers are starting to see that and sort of come back into the sector.
We've also seen the inversion of institutional 70% domination. We're now seeing that revert to about 70% being independent and licensed boutiques. From an insurer or underwriter's perspective, does that, because there's a lot closer relationship of directors to advice provided, is that also diminishing risk and one of the reasons for easing up in the market?
Yeah, definitely. We are seeing the IFAs they're led by their founder and principal, so they've got a lot of skin in the game. I think one of the big issues was with the dealer group model, there might have been not as much oversight, and certain corporate authorised reps might have gone rogue, and that was an issue. Whereas the IFAs, we find they're typically operating under the one roof or only a couple, and there's good oversight, systems are in place, and you know, they're doing the right thing by their clients, and as a result, it's well a well-managed business, and the loss ratios just aren't really occurring in that space.
Fantastic. What are you seeing in the Australian market across all insurances?
Directors and officers is one that's we're starting to see the rate increases reverse. So that was a sector that got hit particularly hard, and the reason for that was the rise of shareholder class actions, and something that drove that was litigation funders, and a number of big companies, even market darlings like Bellamy's, got hit with class action. Slater and Gordon, who were who would you know, they were involved in class actions themselves. QBE were one of the insurers who got hit as well. So yeah, that wiped out a lot of the premium pool and drove D&O rates quite high. But I guess what's happened in recent years, we've seen a slowdown of the IPO market, which typically means a reduction in the D&O premium pool. So there's a bit of a fight for top line growth again there, which is driving rates down. The other big space is cyber, and obviously there's been a number of high profile hackings in recent years. We've seen Medibank, Optus, Latitude, but SMEs also get hit in that space. And I think with lockdowns and people working from home, systems weren't up to scratch. Employee training might not have been there. So yeah, ransomware attacks were occurring all over the place, and yeah, cyber rates increased as a result due to their loss ratios. And we're seeing that plateau again, and I think that's a result of more awareness, people coming back to the office, and an improved focus by businesses on cybersecurity measures to prevent the hacks from happening.
Yeah, I know there's a lot more focus from our industry on cyber. What are the keys to success for a successful submission document?
Yeah, it's look, we always say the proposals forms don't tend to tell the story very well. So it's really in the best interest of these firms to get their story across a different way, which is, I mean, it could be a meeting, or it could just be putting together more of a PowerPoint presentation to sell the story, and just highlighting the business, their purpose, their focus on compliance, what risk management have they put in place, who are they using for compliance, you know, maybe the adoption of tech, who are their clients, is it retail, wholesale, what's the split, their APL, and yeah, just to focus on sort of the products that they're recommending, not creeping up the risk curve too much, or if you do, you know, it's demonstrating who your clients are, why you're comfortable with those products, and yeah, that's probably the key. But I think, yeah, partnering with a specialist broker, because the insurers also have different risk appetites for different types of business. So one group who might be doing certain things might not be with an appetite for one insurer, but it might be for another. So I guess it's partnering with a broker who knows the space and knows who to take the account to.
There's also a seasonality too. You know, with Lloyd's, for instance, they work off the calendar year, like the rest of the UK. So submissions should actually be in there early when the books are full, rather than mid or late in the year. Is that correct?
Yeah, that's right. I think that became an issue. I think previously it was good to maybe have your accounts due in December, because it meant everyone's going on holidays and you know, no one's attacking your clients. But I think with yeah, when capacity sort of dried up, that's what happens. It gets to a point where Lloyd's can no longer take on any more risk. They're at capacity, and if that happens in November and you're due in December, they might just say, we're sorry, but we can't do it. So yeah, we did see that occur.
Right. The last one, the question I had is, do you think the quality of advice review is going to have an impact, positive, negative, or neutral?
Yeah, so it's interesting. I think my take from what I've seen, I know that Stephen Jones has approved, I think, 14 of the 22 recommendations, and they're all aimed at improving accessibility to advice and also reducing the cost of advice. And I think the measures being implemented appear to be quite sensible. It sort of appears to be removing red tape and compliance burden for issues that aren't of adding any value to the consumer. And with that, I think, streamlined SOAs and reduced compliance around fee disclosure and whatnot, I think they're sensible, and I don't think that they're going to lead to bad behaviour, which will lead to claims. I think the big issue is allowing super funds and insurers and banks to re-enter the sector. That's probably where we've seen issues in the past, but just because that happens, it doesn't mean the key insurers for IFAs are suddenly going to start writing that business. So I think they're going to be careful in adopting, in taking on these larger institutions, which means I think the IFAs are going to remain their core focus, and that's going to mean the loss ratios stay down. I guess the thing I believe the good advice mandate hasn't been approved as of yet, which could be problematic in the sense that what is good advice? It's quite a broad term, and does that mean that some planners may go rogue? But I think overall it all looks to be sensible and unlikely to sort of drive bad behaviour and more claims.
Yeah, my reading of it is a lot of the disciplines that have been created over the last few years will be retained. And it's just an ease of reporting, but the diligence and disciplines won't wane. We're still too scared of ASIC and all the other, governing bodies, and rightly so. Mate, is there any other thing you'd like to say to the independent marketplace that we haven't covered?
Not so much. I think, I think I'm quite optimistic for the future. I think it is a good space. I think the industry's moved to improve their professionalism all around. The educational standards and an increased focus on compliance is a positive story. I think more competition in the space in terms of PI insurers expanding their capacity, and new capacity coming online is good for the industry and future sustainability of costs. I guess one thing I was sort of interested to chat to you about is the runoff piece. I know that tends to be a big upfront cost during a sale process, and given the work that you do, what's the attitude from Sweeters in regards to runoff for a business?
So buyers want a period of time, and some, want it for 3 years, and I've seen, at a recent one there was 5. The reality, though, is that 1 is suffice, in as much that all clients must be seen. They must receive new SOA or advice from the buying group. And with that, even if the recommendation is maintenance of the status quo, they then become responsible for any of the advice delivered. Mm-hmm. So for me, a runoff of currency of 12 months, plus you've got the additional protections of warranties and indemnities within the contract of sale, there's sufficient amount of protection to be built in over just having it for 12 months. So that's sort of our view. It is cost prohibitive to go extend that beyond. An average business runoff insurance can be somewhere around, sort of $15,000. And that's for an average business. Sort of probably around the 700,000 revenue. And if we go for another year or two, it just becomes too cost prohibitive, and it impacts on the net result from the vendor perspective.
Yeah, I guess it's interesting what you say there. I I mean, situations that come to my mind. What about if there's a fund that might have been recommended by the firm that's been acquired, and it gets frozen the year after it's been recommended by the new advisor? Are they going to maybe want to recommend that advice, sort of own that advice, or are they potentially going to say, we wouldn't have suggested that fund, but it didn't make sense to move out of it. We don't really think that we should be wearing the brunt of this. What's your take on that?
I suppose we haven't seen freezes since the property crash, but not to say that it can't happen, and particularly where we are with interest rates again, leverage levels within that. I think it's at the same time what most buyers and sellers have normally in matching sort of investment philosophies. They're normally typically they're using generic type of research as well. So I don't find there's normally a lot of product or discrepancies from one recommended list to another. If there was, then potentially you have to do a carve out of that sort of product. For instance, if a business had exposure to a structured product, for instance, and the buyer didn't have that, what we would do is there would be a whole nother sort of list of indemnities and warranties for that particular sector or fund, and potentially there may be additional requirements. But even the structured products, you normally have, you know, a sunset clause on when they cease. So you might have something built around it, but it's extremely rare that there's really, most approved product lists in reality are pretty vanilla and generic.
Yeah. What about insurance advice? I guess that's one that's not really going to be problematic until claim time. Is it a similar story? Are the suitos going to typically be recommending the same insurers to as the business that they buy?
Yeah, well, I suppose the vast majority, it's very rare when you have a look at a risk business and its underlying underwriters that it's not, you know, pretty much spread. It used to be that there would be bias depending upon the dealer ownership when there was institutional ownership, and you would find MLC product for an MLC dealer group, AMP, AXA, but that really has diminished. It now is whatever's best fit for purpose for the clients and best interest.
Yeah. So
there's a diversity now. It's not, you know, and I think this is one of the great things that have come out of the Royal Commission, is that we're at the transparency now. That it must be best product. It needs to be proven that it is. So look, the only thing is that I think the prices in insurance are probably artificially suppressed until we get the lift review, and we know that remuneration is you know, going to remain constant. But we just need to know. When there's legislative risk, then there's suppression on price. And we've fallen from 3.5 times recurring revenue to 2.5. So I'm looking for, hopefully this year, we're going to have some clarity on that issue out of Treasury.
So I guess when it comes down to the runoff cost, can they not simply be factored into the sale price, or is it?
It can, but normally you've got a capital payment versus an expenditure payment. Most of the proceeds from any sale will be rolled over into super. And yes, you can put some of that aside as for cost. But yeah, every vendor is looking on a net basis. So when a buyer looks for an additional cost, quite often it competitively leaves them as the underbidder.
Yeah.
Jared, I think for timeliness purposes, we can end there. Thank you very much for your insights. I'm sure others are really going to appreciate it.
Yeah, no worries at all. Good to catch up, Steve. Cheers.
Good talking to you.